Let's study EA Capital's market temperature card to get a sense of where we stand in the economic cycle and what should investors expect going forward. In this video, we will first analyze the data in market temperature card, as on November 7, 2023, and then summarize our view in later part of this video. If we study different segments of the markets, in terms of large cap, mid cap and small cap, the Nifty 50, which is the large cap segment, offers an earnings yield of 4.78%, which means PE ratio of 20.9, seems to be relatively cheaper, compared to mid and small cap. In valuation terms, Nifty 50 is followed by Nifty Small Cap 250 at a PE ratio of 24.3. The Nifty Mid Cap 150 index continues to be most richly valued at current juncture with PE of 24.90. If we further look at bond yields, the India 10-year bond is currently offering an annual yield of 7.28%. The yields have cooled down, compared to our last reading in October, which is positive for Indian equities. The American Dow Jones Index is trading at a PE ratio of 24.8, which means an earnings yield of 4.03%. Compared to this, the 10-year US bond offers a yield of 4.59%. Brent crude price currently stands at $85.9 a barrel. The crude oil prices have also softened, which is a big positive for Indian economy and Indian rupee's relative strength against other currencies. A strong Indian rupee is looked at very positively by foreign institutional investors. The volatility index, known as VIX or the fear index, is at a value of 11.19, which is higher than our previous reading, but still very low, and this signifies complacency among market participants. We at EA Capital read a low VIX value as a contra-indicator and prefer to remain prepared for higher volatility in near future. Tickertape's Fear Greed Index depicts a value 49.9, which is in the fear zone but very close to greed zone. If its value goes beyond 50, we take the Fear Greed Index as a contra-indicator and have seen time and again markets showing resistance when it reaches extreme greed zone and support when in extreme fear zone. Currently we are right in the middle of fear and greed. The BER ratio, also known as bond to equity earnings ratio, is at 1.52, which is arrived at by dividing the earnings yield of India 10-year bond at 7.28% by Nifty earnings yield of 4.78%. BER ratio has quite significantly come down compared to our last reading of 1.63, primarily because of lower bond yields and higher Nifty earnings yield. According to our reading, the BER ratio at 1.52 signifies slightly above average valuations for Indian equities, but with very positive real GDP forecasts for Indian economy, expectations of improved corporate profitability in coming quarters, expectations of interest rates further cooling down, inflation remaining under control, it looks unlikely that broader Indian markets will see a deep correction from these levels, and outlook remains positive for Indian equities from a medium to long-term perspective. The macro indicators continue to suggest very strong on-the-ground economic activity and growth. GST collections continuously remain very strong, with latest number at over Rs 1.72 lakh crore for the month of October 2023. This is the second highest GST collection ever recorded, and this figure represents a significant 13% increase compared to the same month in the previous year. Along with GST collection number, both manufacturing and services PMI also signify expansion in manufacturing and services sectors, though the pace of expansion has slowed down compared to our last reading in October of 2023. Investors should note that a value of over 50 on the PMI index signifies expansion. Along with this, India's forex reserves stay strong at over $586 billion. Our forex to external debt ratio stands at a healthy 95.45%. At EA Capital, we put in a lot of effort to create these videos, so if you like our content, please support us by hitting the like button and subscribe and share our channel. To summarize, our reading of the data says that the Indian economy continues to display strong fundamentals. Our real GDP growth outlook remains positive, and we remain one of fastest growing major economies in the world. Regarding flows into Indian equities, for the month till November 6, 2023, foreign institutional investors sold shares worth net rupees 3,613.87 crore while domestic institutional investors bought shares worth net rupees 2,467.23 crore. In the month of October, foreign institutional investors offloaded shares worth net rupees 29,056.61 crore while domestic institutional investors added equities worth a net rupees 25,105.86 crore. Markets seem to have digested the fact that there are geopolitical tensions across the globe and seem to resume their upwards journey as global markets are factoring in that interest rates are close to peaking out and hence markets are anticipating lower interest rates in the not-so-distant future. Lower interest rates are great news for equities as an asset class as it improves liquidity and makes fixed income less attractive. Lower interest rates also spur economic growth as cost of capital gets cheaper and it's easier for corporates to expand their operations during cycles of falling interest rates. Investors must also be aware of risk factors which can dampen the positive sentiment. For Indian equities, these may be a. Uneven distribution of monsoon, hence rural economies' growth can remain under pressure. B. Escalation of geopolitical tensions and involvement of other countries in the war between Israel and Palestine can potentially take crude oil prices higher, hence, higher global inflation and higher for longer interest rates, which can derail and slow down economic growth. Higher crude oil prices for longer periods of time can negatively impact India's current account deficit and forex reserves and can pose pressure on Indian currency, thereby negatively impacting foreign flows. C. Markets seem to be pricing in political stability and continuation of reform process after the upcoming elections. Election results otherwise may possibly create upheaval. D. In equities, many unforeseen risk factors, which are not mentioned above, may have a significant negative impact in near term, though, in long term, earnings growth of investee companies tends to decide the returns earned by investors. What we would do with our portfolio, we will continue to remain focused on asset allocation in terms of equity and debt. We plan to stay invested in quality Indian equities, primarily through mutual funds, and along with it stay invested in high credit quality debt and high credit quality ultra short-term or liquid funds to have liquidity available to take advantage of the inevitable volatility in equity markets. We also plan to rebalance portfolios at opportune times, from pockets which we feel may be overvalued or if asset allocation between debt and equity deviates too far from our decided percentage allocation between debt and equity. Please note that the comments and views shared in this video are our personal views, as per our own understanding, and this should not be treated as any recommendation for buying or selling investments of any kind. Investors must do their own independent research, consult their investment advisors before making their investment decisions. We have done our best to ensure accuracy of data shown in the market temperature card, though, in rare case human error may be possible. For a one-to-one discussion with a highly experienced and knowledgeable finance professional at EA Capital, who always keep your interests ahead of everything and work in a completely transparent manner, you can write to us at info@eacapital.in, and one of our team members will get in touch with you.